Welcome back, Focus Learners, to today's Explainer. I am absolutely thrilled you're joining us for this one. Today, we're conducting a comprehensive analyst briefing on ServiceNow, trading under the ticker symbol NOW. We're going to dig into the hard financial data to answer one really critical question. Does this company represent a durable, long-term buy and hold opportunity for the patient investor? We're strictly relying on the numbers here, folks. We're hunting for quality, growth, and undeniable value. Okay, let's dive into this. Here is our highly structured roadmap for today. 1. The ServiceNow snapshot. 2. Financial health and growth. 3. Tracking the cash flow. 4. The DCF intrinsic value. 5. EPS forecasts and scenarios. And finally, 6. The long-term verdict. We're going to peel this onion from the macro company profile all the way down to the final valuation. Let's start with Section 1, the ServiceNow snapshot. Company details. So before we look at the underlying financial engine, we really need to establish exactly where ServiceNow sits. They operate in the highly lucrative tech sector, specifically within application software. But I really want you to anchor your attention right now on that current market price, $106.32. Lock that number in your mind because it is the crucial benchmark we're going to use to measure value throughout the rest of this explainer. We're also looking at a forward price-to-earnings ratio of 21.15, which kind of gives us a hint at how the market is currently pricing its future growth. And when we talk about this company, we are not talking about some scrappy little startup. We're evaluating a massive enterprise with a market capitalization of $109.65 billion. This immense figure perfectly illustrates the sheer scale and heavy institutional weight of ServiceNow. This is a dominant player with a massive, massive footprint. That brings us to Section 2, Financial Health and Growth, Growth and Margins. We're moving from this surface-level snapshot right into the fundamental financial engine that drives their daily operations. And this brilliantly illustrates exactly the kind of high-quality, scalable software business long-term investors just dream of. I mean, look at that year-over-year revenue growth, a robust 22.10%. But what really jumps out is that stellar gross margin of 76.56%. Think about that. When a company can retain nearly 77 cents on every single dollar of revenue before operating expenses, it has immense pricing power and scalability. You add in a healthy operating margin of 13.34% and a net profit margin of 12.59%, and you've got yourself a highly efficient wealth-generating machine. Tracking the 4-year income statement spread, we see a really compelling story of aggressive, consistent top-line growth. Total revenue surges from $7.25 billion in fiscal year 22, and it's projected out to an impressive $13.28 billion by fiscal year 25. But importantly, and this is key, this isn't just growth for growth's sake. Look at the bottom line. Net income scales massively, leaping from $325 million all the way up to $1.75 billion. They are aggressively growing revenue and, more importantly, effectively translating it into expanding profit. Now for Section 3, tracking the cash flow, cash generation. For serious, long-term investors, earnings on a spreadsheet are great, but actual cash in the bank is king. Breaking down the cash flow, we can see exactly how efficiently this company compounds capital. Operating cash flow practically doubles from $2.72 billion in FY22 to a projected $5.44 billion in FY25. Even more importantly, free cash flow, which is the money left over after the business has paid to maintain its assets, grows from $2.17 billion to $4.53 billion over the same period. Now, what's really interesting when we map out this relentless year-over-year compounding is that it reveals this beautiful upward staircase of cash generation, going from $2.17 billion to $2.70 billion to $3.38 billion in just 3 years. That shows incredible consistency. Predictable, expanding free cash flow like this gives ServiceNow massive capital allocation flexibility, whether that means reinvesting in the business, acquiring new tech, or buying back stock. And because of that strong cash generation, ServiceNow boasts a price-to-free cash flow ratio of 28.82. For long-term investors, this ratio is a vital indicator. It literally tells you exactly how much cash flow you're getting for your investment dollar today. In the high-growth tech space, a P to FCF of 28.82 is a very healthy sign of a business that actually backs up its valuation with real cash. This brings us right to Section 4, the DCF intrinsic value valuation model. We're now reaching the climax of our analyst briefing. We have the fundamentals. Now we need to mathematically value the company using a discounted cash flow model. To build an accurate model, we obviously have to use realistic inputs. Our base scenario parameters include a weighted average cost of capital, or WACC, of 9.10%, which accurately reflects the risk profile. Our revenue growth assumption matches their historical 22% rate, tapering down to a terminal growth rate of 7.70%. And we account for 1.03 billion shares outstanding. These projections are not just pulled from thin air. They are strictly grounded in the historical data we literally just reviewed.
But right before we reveal the final valuation, it is absolutely critical we define the margin of safety. This is the foundational principle of value investing. It simply means an investor only buys when the current market price is significantly below the mathematically calculated intrinsic value. We aren't just looking for a fair price here. We are actively hunting for a deep discount that provides a real financial cushion against unexpected risks.
So the crucial point is this stark contrast. The current stock price, what the market is asking you to pay today, is $106.32. But based on those robust cash flows and conservative growth assumptions, the DCF intrinsic value, what the stock is mathematically worth, is $208.30. That gap translates to a staggering margin of safety of 96.88%. Finding a margin this wide in a mega-cap tech stock is honestly like finding a unicorn. The DCF model emphatically suggests that, based purely on the cash the business is projected to produce, the stock is significantly undervalued right now by the broader market.
Moving along to Section 5, EPS forecasts and scenarios, alternative valuation.
While the DCF model is a highly powerful tool, a smart analyst always double-checks their work, right? We have to pressure test our thesis by looking at different earnings per share, or EPS, scenarios. Even if we assume a completely conservative one-year scenario, the intrinsic value comes out to $104.18, basically flat against today's price, with a tiny negative 1.53% margin. But in a highly likely moderate scenario, the intrinsic value hits $139.17. That represents a 31.54% margin of safety over the current $106.32 price in just a one-year outlook. And in an aggressive scenario, that margin jumps to over 58%. Let's move further out and see how this builds over time. In these 5-year EPS scenarios, the compounding effect creates staggering potential intrinsic values for patient capital. A moderate 5-year outlook prices the intrinsic value at $279.09, a massive 163.79% margin of safety. This perfectly illustrates the sheer power of buying a growing company at a steep discount and just letting time do the heavy lifting.
And finally, Section 6, the long-term verdict, final analysis.
Let's bring this whole analysis home by summarizing all the hard data we've unpacked in this briefing. We began with a highly scalable business boasting 76% gross margins. We tracked the compounding free cash flow, seeing it practically double. We then fed that exact data into our models, leading us to a definitive mathematical conclusion. The verdict is clear. The intrinsic value of $208.30 is far, far higher than the current asking price of $106.32. Driven by that sustained 22% revenue growth and exceptional cash generation, the hard data concludes that ServiceNow appears severely undervalued today. Which leaves us with this one final question. Knowing that this massive enterprise is generating billions in free cash flow, scaling its net income aggressively, and presenting an incredible 96% margin of safety in the base model, is ServiceNow your next long-term hold? I highly encourage you to weigh the overwhelming data we presented today and decide your next move. Thank you so much for joining me for this explainer. Keep learning, keep analyzing, and stay focused.